Hello and welcome everybody. Happy Friday. Hope everyone had a lovely 4th of July and is ready for another weekend. But first, I have quite a bit of information to share with you all today. Next Monday, July 11th, is going to be the beginning of our Figuring Out Finance webinar series. That series is aimed at students and beginners who want to get a strong understanding of what it means to have money. You can earn money, you can spend money, and you can save money. But all of those, you need to know what's going on. You need to know where that money is going, and more importantly, how you can manage it. Taking control of your finances is a necessary and an important part of our education. And unfortunately, it's an education that most schools, even the really good schools, don't teach. So, while that class series is meant to be a comprehensive education to help you get started, I first wanted to talk today about 6 different necessary topics that I feel are very, very important for you. Many of these topics we will cover in the Figuring Out Finance series, but 2 of them didn't really fit into the series, but I still wanted to bring up with you all and share some details about them. Because as soon as you start to make money, good old Uncle Sam wants their cut. So I want you to understand some basics about things like taxes, but also investment accounts and savings, and also what it means when some big talking head on the news says, we're in a recession, we're in a bear market. What does that mean? More importantly, why do we care? We'll answer all those today and more as we set up the groundwork for our Figuring Out Finance series, as well as share our 6 necessary topics for anyone looking to get a strong start for their financial journey. So, let's get straight into the action. So, the goals for today's webinar are that, like I said, our class series, also let me move over this way a little bit. Our class series for Figuring Out Finance will be beginning on Monday, July 11th. To help set up the framework for that class and to give some additional information that the class won't exactly cover, we want to share 6 financial topics that we feel everyone should know. 2 of the topics today that the Figuring Out Finance series won't cover, we'll cover in detail. And then the Figuring Out Finance series will help us take those other 4 topics and take them into much greater detail. But more importantly than detail, those classes will help you take the topics and immediately apply them to your everyday or to your future life. So, let's do it. Let's start off with the easiest one. And by easy, I mean it's the most complicated one because it's kind of designed to be that complicated. Taxes. Now, before we even get into things, disclaimer, I'm not a CPA. I'm not an accountant. Tax regulations and laws are incredibly complicated and they change every year. Also, what taxes you have to pay change depending on where you made your money, where you're living, what state, or even sometimes what city you're in. So today is not meant to be tax advice. This is not meant to be how you set up your taxes. This is meant to be an awareness campaign. It is supposed to bring more awareness to when your employer takes money out of your checks. Where does it go? Does it just disappear? No. And we'll talk about where it goes today. So it's meant to be a basic understanding of taxes, the different types of taxes that you will probably see, and then also I want to provide you some resources on how you can file your taxes for free. Now, let's get started on talking about what income tax actually is. Taxes are Uncle Sam's way of getting some of our money. We make money by working, and the government wants a little cut of that. The government does many things for us, like maintains roads, sets budgets, and handles basic utilities for many cities. And much of our money doesn't go to that. So they need to get that money from us somehow. And income tax is one of the ways that consumers, like you and me, and then companies will pay or give money to the government. Give feels like a weird word. It's not an option. You have to pay your taxes. Otherwise, Uncle Sam comes for you. These taxes are used to generate funds for local, state, and federal governments to use for various purposes. But what taxes you pay changes depending on where you live and where you made your money. For example, if you live in San Francisco, Denver, New York City, you're going to be paying city income tax on top of state taxes and federal taxes. Or if you live in Macon County in Alabama, you don't pay a city tax, instead you pay a county tax. Some cities and some counties have those local taxes, but not all. Just like not all states have state taxes. Some states, such as the Lone Star State, Nevada, and Florida, all have no state income tax. So all you would pay if there are no local taxes is you would pay federal taxes. Now, this is part of what we will cover about taxes. Let me just quickly mention what we won't cover. I'll tell you this right now. Tax laws are incredibly confusing. They're very complicated, they change every year, and the rules and regulations around how and what taxes you pay will change pretty wildly depending on if you're married or not, if you have kids or other dependents, if you have any disabilities such as blindness, and also if you're above or below the age of 65. All of these things don't even start to consider other places that you've made money, like investments, or other places that you might have lost money, such as tax payments for property. So to keep things simple, we're going to assume a couple things. One, that all we're going to talk about is income that you would have made through your job, whether you're self-employed or employed by someone. Also, we're going to assume that you've made enough money that you are required to file your taxes. Again, not everyone will make enough to file their taxes. So we're going to ignore that, and we're going to solely talk about if you made enough to have to file. Now, every year, you report your tax payments to the government. And when you do, you will have to change how much you either paid, you might have to pay extra, or you might have to pay less, which means you get money back by filing your taxes. These filings will consider all of those things that we mentioned before, such as marital status, dependence, disability, and age, as well as include any other income that you've generated, and will help you figure out, well, they don't help you figure out, they will basically tell you how much you owe. They are not perfect, but unfortunately, this is the best that we've got. So let's talk about some extra little considerations that we need to make here. If you're employed by somebody, chances are when you first started your employment there, they had you fill out a form. Some of those questions on the form will say, are you married? Do you have disabilities? Do you have any kids? All of these are deductions. It's trying to figure out what deductions you may have that would help you pay less in taxes. Why does your employer need to know that? Well, because when your employer gives you a paycheck, they don't just give you all of the money that you owe or that you would have made. Instead, they don't give you it all. They give you most of it. And then a good chunk of that, they will what's called withhold. They will withhold that money and then send it over to the tax groups, local, state, and federal, on your behalf. It's not like they're stealing your money. I promise they're not stealing your money. They're paying your taxes for you in accordance to how much you would have made from, or how much you would have owed based on how much you're making. Now, these payments are not perfect. In fact, you can choose to list all the deductions and get most, if not all, of your paycheck, but then you'll have to pay taxes later and you'll have to deal with figuring out how much you owe. Or you can claim no deductions and then when you file your taxes, get a refund from that amount. And also, this only considers income from your employer. If you have other income, such as investments, or if you have losses from things such as cryptocurrencies, lots of losses for that this year, those will also offset your income. So you might end up getting money back. So when you go to file your taxes, you'll get documents from your broker, from your company, from whoever. Wherever money went in or came out, they will give you a tax form that will help you figure out how much did you pay in taxes, how much should you have paid in taxes, and then you either get a refund if you paid too much, or you pay extra if you didn't pay enough. These tax deadlines change every year, but they typically will fall in April, in the middle of April. COVID did change that, though, pretty significantly. Now, if you are self-employed, you pay additional taxes on top of all of those taxes we already talked about. Well, one, if you're self-employed, the employer is not sending in your tax payments, so you have to do it yourself in what are called quarterly estimated tax payments. So every quarter you pay a certain amount to your state, local, or federal government. Additionally, you have to pay Social Security and Medicare taxes. The amount that you end up paying in taxes becomes pretty significant. But how do you actually put all this in one big thing to tell Uncle Sam how much they owe you or how much you owe them? You have to do what's called filing. If you make above a certain amount, you are required to file an income tax return. In this return, you list all of the taxes that you may have paid throughout the year, either as estimated or as withholdings from your company or from your paychecks, as well as you would report any earnings or losses that you've gained from investments or other sources of income. And again, we've only touched the very surface of this. I'm not a CPA. I'm not going to begin to pretend that I am one. There are no bigger headaches in my life and many people's lives than taxes. And unfortunately, it's confusing because it's kind of meant to be confusing. There are companies that spend millions of dollars lobbying to try and make taxes confusing and difficult and as non-automated as possible. For example, if you live in the UK, the government sends you a letter saying, here is what we collected. We got all your tax documents. We figured out that you owe $600. Is this correct? Yes or no? If it's correct, yes, you just pay them the $600 and you're done for that year. They file your taxes for you. In the US, that's not how it is. We have to file our own taxes, and filing them is incredibly complicated. Because the same companies that are lobbying to make taxes more confusing are also the ones that want you to pay them to do your taxes for you, or to help guide you through doing your taxes. Thankfully, 600 pounds, yes, 600 pounds, not dollars. But thankfully, Uncle Sam has made sure that even these companies give us an option to file for free, provided we make less than a certain amount in revenue. So, like I said, there are some ways that we can file for free. Two of the ways that we can do it, funny enough, are both available on the same website page, the IRS Free File page. And I will give a link to that as I go through the slide. If you make less than a certain amount in what's called AGI, or adjusted gross income, you can file for free through these tax-guided programs. They will walk you through the process, they'll ask you a bunch of questions, and they'll try and help you get as much money out as you can. Only if you make less than this amount. If you make more, they're not going to tell you until you get to the very end of the process and then say, well, you made too much, you now need to pay us $150. You think I'm kidding, but it's happened to me 2 years now. It's happened to me where I'll get to the end of it and they'll say, you made too much, sorry, you have to pay us. And you don't get an option if you want to just leave it, export everything that you've done, and then go handle it somewhere else. You have to start all over. There's a reason I really don't like filing my taxes. But you can file for free. They will help you out, but it does come at the risk of if you end up over that adjusted gross income amount, they're going to ask you to pay and not give you the very easy option of transferring over everything to someone else. But you can also go ahead and fill out the forms yourself. All a tax preparation company is going to do is fill out the form for you. You give them the info and then they fill out the forms and mail them in for you. If you really want, you can go through and do all of that yourself and fill out the forms yourself. With that, there is no limit to your income, as long as you can deal with the complexity of filing your own taxes with these forms. And again, all of this is just the beginning. Taxes are confusing, but they're also necessary. We don't have a choice. We need to deal with them, and this is the best way we can do it. So with that said, here's a link to the IRS Free File options. So if you're curious to see what choices you would have to file your taxes, this page will list them out for you. And again, today is just meant to be a quick outline of what taxes are, some of the things that go into taxes, and also where you can file your taxes for free. Prior to making any decisions, you need to understand everything for taxes as it applies to that year. Every year tax law changes. Every year there are more or less deductions that you can claim, and part of the benefit of these tax professionals is that they'll know what those laws are and they'll know what the little deductions that you can collect are. Wouldn't it be nice if that was all done for us? But that's not the situation. So again, please, if all of this stuff is new to you, know that this is not all the information you need. You're going to need to do additional research before you file your taxes, and either talking with a CPA or doing more research is going to be a very important part of that process. Now, let's move on to something a little bit more topical to us. What about the optional services like TurboTax? That is the guided tax professionals thing that I was talking about. So if you go to the IRS Free File page and you click Browse All, it will show you all of the different companies that offer something for you. So you were saying Tax Act. Let's see, where is Tax Act? Let's say, oh, come on. I'm not dealing with that. Tax Act is on here, and their adjusted gross income limit is something around, I'm not even going to pretend like I know what it is. But they do have a free file option. What it is, let's see. It's Tax Act Free File. There you go. 56 or younger, adjusted gross income of $65,000 or less. Or if you're military, less than $73,000. If you make more than that, and keep in mind, adjusted gross income does include investments. So even though you might have earned $60,000 from your employer in gross income, if you made more than $5,000 in earnings from stocks, you're now above that limit. And they're not going to tell you that until you get to the very end of the process. So it is pretty wild how frustrating this entire process is. Anyone that has filed their own taxes can probably attest to that. So, that is the basics of taxes, and it only took us 20 minutes to do it. But again, this is not a topic we'll be covering in figuring out finance. This is something that I wanted to provide as much information today as I can and should, and then provide you resources for where you can continue your education if and when necessary. Now let's get to something a little bit more interesting to talk about, because it talks a little bit more about stocks and money, not so much Uncle Sam. And it's also very, very topical to what's going on in the world right now, or in the US right now, which is, by the way, if you're watching this recorded, today is July 8th of 2022. Bear markets. Bear markets and recessions in particular. Right now, we're experiencing a period of losses in the stock market, which is known more kind of topically as a bear market. The bear market is, well, I'll describe it in a couple minutes, but we are right now in a bear market, which is a downtrend on average across the stock market. And we are also close to a recession in our economy. These are terms that might not mean anything to you, but you know that they're not good terms. And the news kind of relies on that. They rely on you not knowing the full information of what a recession is, and what a bear market is, and why they matter, and how, more importantly, do they affect you. So today, I want to just try and dispel some of that fear, explain what these topics are, and more importantly, why you shouldn't fear them as much as the news might want you to. So let's start off with a bear market. A bear market, by the very technical definition of it, is a period where an index or a market is 20% or more below its high point. So the market might go up and up and up and up. It'll have its couple ups and downs, then get as high as it can go. And then it'll drop back down. From that highest point to wherever it is, if that gets below 20%, we hit a bear market line, or we fall into a bear market. One of the most common indices that we'll look at is called the S&P 500. It is a group of 500 of the largest, not the largest, but of the largest US companies. For the S&P, this high occurred on January 4th of 2022. Since then, we hit a market bottom, which is the lowest point we've seen this year, on June 17th, where the market was down 23.4% from that high. Right now, things have recovered about 5%, where we're currently 18.6% down. But we're still in that bear market, and will be until we recover value up to that January high. Now, why does it matter? Well, as some people are talking about in the chat right now, stocks are a place that a lot of people, and namely investments, or where a lot of people put their money. They'll put it in stocks or long-term funds or other long-term investments, where they try and hold it for a long period of time, because historically, stocks have trended upwards over time. To show that very clearly, let me just quickly show you a graph of the S&P 500. Let me see how big I can get this chart. No, there. Stop. All right. We're now looking at the S&P 500 ETF, or exchange traded fund. Figuring out finance, we'll talk more about what that is, of the S&P 500, which is SPY. January 29th of 1993, it was $43.94. It went up to 140 something before the dot-com bubble happened. It went back down, recovered to 140 something in 2007. The housing bubble popped and brought the S&P down with it. It recovered by 2012, boomed up until it hit 330 in 2020. Then this whole little pandemic thing happened. It dropped back down, recovered in 2 months, reached its all-time high at the beginning of this year before dropping that 20% like we mentioned earlier. Every time there has been a bear market, in 2000, in 2008, and in 2020, the market has recovered. And we're only looking back to 1993. If we extended this all the way back, even through the Great Depression, markets have always recovered in the past. So in a bear market, like we are experiencing right now, when many companies are losing value, it's going to cause short-term and even sometimes medium-term losses for investors. Like we saw with that 2008 example, it took 4 years before that value recovered, but it did recover in the long run. The danger of a bear market is not the short-term losses that it accumulates. It's the fact that investors are going to hear lots of panic. They're going to hear other investors, or they're going to hear the news talking about how cataclysmic, how horrible what's going on is, and want us to panic. When we panic, we sell. When we sell, that only drives prices down even more. So, should we fear a bear market? It's difficult because when you're going through a bear market, it is not a very fun experience. You see investment accounts go down, and many of those investment accounts are long-term savings in forms of retirement accounts that we'll talk about later. But over time and in the longer run, we will always see these markets recover, bounce back, and always grow to higher highs after. Or at least they have always grown to higher highs. We never know what's going to happen. So that's a bear market, and that's more importantly how we're experiencing it right now. Now, what is a recession? A recession is a period of time where the economy, which is not just the stock market, but everything that we spend or gain money from, goes backwards, or, as the name implies, recedes. Recessions will usually occur after periods of excessive growth, where growth outpaces our ability to make money. Everything becomes more and more expensive, but we're not making more and more money to match it. That is unsustainable, and that's what we're feeling right now. Here's the cycle that sets up a recession and drives us further into a recession. And tell me if this sounds familiar to what we've experienced over the last 6 months. Things get more expensive. Gas gets more expensive. Groceries get more expensive. Chipotle burritos get more expensive. When things get more expensive, we're less likely to want to spend our money because it's way more expensive for us to spend our money. When we spend less money, then companies won't make as much money. When companies make less money, they stop hiring. They might even start laying people off or firing people to try and cut down their costs. When they start firing people and laying people off, that leads to higher unemployment. Higher unemployment leads to less spending money, which then people spend less, which means that companies make less profit and then they lay off more people. It's this horrible cycle that continues getting worse and worse until at a certain point it bottoms out. And thankfully that bottoming out is a point where it finally reaches an equilibrium. Costs get back under control. Employment starts to go back up, or employment rates, so unemployment rates start to go back down, so people are finding jobs again, and we start to see periods of recovery. Now, question on many people's minds, should we fear a recession? I've talked in detail about this with Sectors Made Simple subscribers over the last few weeks. We've taken a look at how these recessions look, what the current forecasts of a potential recession in 2022 looks like, and more importantly, how stocks and ETFs change over that period. But for everyone right now watching this, I want to answer this question. Should we fear a recession? No. Again, a short-term effect of a recession is not an enjoyable one. Costs are still high, layoffs are starting to happen, and spending goes down. We start to feel the pressure of financial worry more. But recessions are also pretty short-term events when we look at the overall picture of things. Historically, we have been in recessions 25% of the time, which means 3 out of the 4 years, we are in a boom. We are not in a recession. We are in market growth. Then recessions tend to be, on average, 15 months long, so about a year and 3 months. If we were to be in a recession right now, from the technical definition of it, again, no one can tell you that you are not feeling the pressure of increased costs, decreased money, and that challenge of the gap between those. A recession is, yes, a definition, but yes, also a feeling. The feeling of a recession is present right now and honestly has been for quite a few months with the rising cost of gas, the rising cost of groceries, and the rising cost of just about everything except for our wages. So, recessions, though, are unfortunately unavoidable. We live in a capitalist society. People want to make as much money as they can, so they'll try and increase their profits. When that happens, they're going to not increase how much they're paying people because they want to increase profits. That starts to become an imbalance. And unfortunately, a recession is a way for a market to force itself to rebalance. I've used this example many times, and I will continue to use this example. The market is a forest, and a recession is a forest fire. It is destructive, it displaces people, but it is also an unfortunately necessary part of the process because it clears out old growth and it makes room for new growth. It is a way of resetting this environment. And that's kind of what we're seeing right now. Inflation in the US has been increasing steadily for the past year and a half. And as we start to see that inflation rate hopefully top out and go back down, it's also stemming a recession. But at the same time, a period of recession is a period of decreased GDP. When GDP stagnates, inflation typically goes down as well. So a recession will drag down that inflation rate, but at the cost of employment, where unemployment will rise. The Federal Reserve tries to balance these two things, and they're not perfect at it. It's impossible to have a government organization be perfect at managing a free economy. So let's just say this, to keep things simple today, because I've talked about this subject many times over the past month. Avoiding a recession is impossible. So the best thing we can do is prepare for a recession. They are inevitable, but they are also temporary. And one of the one of the best ways that we can do this is by setting up an emergency fund. Setting up a pool of money that you set aside that can be used in case of unemployment, rising costs, anything that is an unexpected increase in your costs or in how much money you need to spend to live. This safety net can be used for that. That brings us to topic number 3, and one of the first ones that our Figuring Out Finance series will cover in a lot of detail. Many of us, myself included, and basically anyone that, wants to have more spending cash, likes to see our checking account go up. Bigger numbers means more money means more spending power means, for many people, more fun. But putting aside money is also a very, very necessary part of this process. Because while you have money to spend today, you need to prepare for if you don't have money to spend tomorrow and making sure that you can still continue to live comfortably. So preparing for this emergency fund is a very necessary part of our process and building strong financial habits. Many people have different ways of doing this, and no one way works for everybody. Someone that works for a company that gives them a big Christmas bonus might take that Christmas bonus, spend it on some gifts, but take the rest and put it into a savings account. Other people might, and this was one that my mom always taught me, take a certain percent of your income and set it aside. When you get a paycheck, take 10% of it, and if you can afford to, take 10% and put it into a savings account. That amount will go up over time. You can take that money and use it for investments or other sorts of money growth. And also, if you are more limited because of your current costs, understanding exactly what your costs are and how much you would need to put aside to build that safety net or save for bigger investments in your life, those are other ways that we can build up that safety net. This is a topic that, again, is very personal. Exactly how much capability you have. Again, not everyone's going to have the ability to take 10% of their income and immediately throw it into a savings account. But other people might not want to have to manage and oversee a spending tracking software that will tell you how much you need to put aside every month to get to your goal by the next 5 years. So there's not one size fits all shoe or one size fits all solution to this. So we want to provide many different solutions and help you find the one that works best for you in the Figuring Out Finance series. So in that series, we will provide projects and resources that will show you budgeting softwares and how we can set them up. And we can start setting up strong habits for putting aside that money for either investments, savings, or putting money towards college education or buying your first home or car. So now we've talked quite a bit about saving money. Let's talk about, growing our money, or where we can put the money that we've worked hard for. The first one is going to be money accounts. These ones are also very commonly called cash accounts. Cash accounts are different sorts of places that you can hold cash or cash equivalents in. The most obvious one that you're probably familiar with is a checking account. A checking account is going to be, you get a debit card that you can swipe when you go to 7-Eleven and pay for things. It has a balance that you put in there, and you can spend that balance immediately to buy things or to get cash out of an ATM. That's a checking account. A savings account is a little different. A savings account is going to be slower access. You're likely not going to have a debit card that lets you swipe to get money out of your savings account. Your savings account also might have a limit to how many times you can pull money from it, or how much money you can pull from it at a given time or in a given month. And the advantage, though, is that yes, you don't have as quick access to your money, but because you don't have quick access to your money, they're using your money for something. And as a thanks for letting them use your money for stuff, you accrue some extra cash. They'll give you a little bit of extra money called interest. We'll talk more about interest later. The third and least common one that many of you might not even have heard of, even if you have a savings account, checking account, and investment account. Money markets. Money markets are cash equivalent accounts that, yes, your money is used for a purpose, but many of these money market accounts offer quick access to your funds and small profits from savings accounts, or that you would see like in a savings account, but with higher yields than savings accounts. Why would you ever have a checking account if you can have a money market account, right? Well, not all banks or institutions offer money market accounts. So your options are going to be very different and also much more limited than the places that you can open a checking account. Some, and honestly quite a few, have minimum balances where you are required to have a certain amount in that account in order for you to maintain it. Others will have a fee that you have to pay per month. Now, these are all places that you can store cash. And that cash is either held as cash or in cash equivalent securities. Let's now talk about turning that cash into security or into other assets. Things that will hopefully gain value over time as you hold it. And to do that, we need to talk about investment accounts. The most common one that you, me, and probably Juan de los Palotes is familiar with and might even have is a brokerage account. These brokerage accounts are places that you put money, cash, and you can use that cash to invest in stocks, bonds, commodities if your brokerage account allows for that. Every brokerage account will offer different types of securities that you can invest in. And a brokerage account is most people's first step into the world of taking money and turning it into investments. And at that, because you're now making money, Uncle Sam wants some of that cut. So that money is oftentimes taxed as income. Now, that's the first place. The second place is going to be retirement accounts. These investment accounts are similar to a brokerage account where you can buy certain stocks or groups of companies called funds, but are a little bit different because they're meant to be for, as the name says, retirement. In a retirement account, there are many more rules about what you can invest in or when you can pull money out of it. But in exchange for those extra rules, many of these accounts are taxed differently. Some are tax deferred, where you don't pay taxes until you pull the money out. Others, you pay the taxes over time, but then at the end, you get to pull the money out with no tax liability. So these retirement accounts are again aimed at optimizing themselves, at making themselves be the best when used to save for retirement. The last one is education accounts. Two more. Education accounts. Education accounts are investment accounts, again, with tax advantages that are geared for helping to save for a student's education. So if you have students or kids that you want to save for their college education, these education accounts are going to be a pretty tax-advantaged way to do that. They, again, come with rules and restrictions. Different ones will have different contribution amounts and different types of education that it can be used for. Can it be used for only education and tuition, or can it be used for student staples and other sorts of material goods that you need. That depends. And there's different types of education accounts that are available. The last one is investment accounts for minors. Seems kind of weird, but it's something that makes a lot of sense. Many parents want to set up their kids to start learning how to invest. Or they want to start putting money into that child's name so that they can start to build up an investment account that when they turn of age, 18 or 21, they can take ownership over that account and start investing themselves. These are accounts that are very valuable, but are also very specific to certain people. So those accounts we will also talk about in our Figuring Out Finance series. All of these accounts, including savings and checking accounts, we'll talk about in the Figuring Out Finance series. We'll differentiate them all, show the advantages of some and the disadvantages of others, and help you get started to understand, based on your goals, what the best accounts might be for you. Now we've talked quite a bit about paying taxes, how taxes apply to our income, how taxes apply to our investments, and also how all of this starts to come together in investing. But there's one type of income from investments that we haven't mentioned yet: dividends. I'm sure that word probably just made quite a few people in this chat light up, because dividends are a very interesting and very beneficial part of investing in companies. Because in addition to making profit when the company goes up in value, dividends provide us another way that we can profit from investing in companies. They are recurring payments that are made by the company to the shareholders, which if you own their stock, that's you, when they make profit and they want to share some of that profit with their shareholders. Not all companies pay dividends. Not all companies pay dividends at the same time, and not all companies pay dividends in the same interval. Some companies will pay one dividend a year. Other companies will pay one dividend a month. Depends. Most companies, though, pay dividends every quarter, if they pay them at all. But there are even some among the dividend providers that we want to give extra recognition to. Regular intervals, so it's consistent how often they pay. They always give you more than you got last time, so increasing dividend amounts, and also a great track record of providing these dividend payments over time. And these three come together in what we call the Dividend Aristocrats. This is a list of companies that have provided dividends in regular intervals and increased their dividend yields every time for the past 25 years, at least 25 years. As of June 2022, there are 65 companies that qualify for these requirements. I'm not going to list them all out, that'd be pretty long, but the students in Figuring Out Finance will go more in depth and study some of these dividend aristocrats and understand how much they've paid out, and if you invested in that company, how much would you have earned, not off of the company going up in value. Forget that. We're only talking about if you got those dividend payments. How much would you have made solely off of dividends? When I talked a couple of weeks ago about ways that we can invest in a bear market, we took a look at some securities that they might not have gone up. They might have stayed the same price, but provide monthly dividends to give you those little paychecks even when the stock's going down. That is the kind of value that some companies can provide from dividends, where even if the company is going down, you still profit because of the dividend yields they provide. So once again, in the Figuring Out Finance series, we will cover all of this and more. as we look at dividends and how they can provide us with a little bit more of a consistent way to supplement gains or offset losses from companies. Additionally, we will also be looking at where all of these companies we can find information about how much dividends they actually pay. Techware. Hi, Jonathan. I'm interested in dividends. How can I get started with dividends? Any tips or ideas? Well, one, the Figuring Out Finance series, we will go in quite a bit of detail and also help get you started in a very actionable way. But if you want to start your own research, two things. One, dividendinvestor.com is a great website to find dividend information. And then two, look into DRIPs, dividend reinvestment programs, where instead of sending you a check for money, what they will do is when you get your dividend payment, they will take that dividend amount and reinvest it back into that company. So not only does your equity, the actual amount of money you own, go up, but the amount that you have invested in that company also goes up. So with a DRIP, or dividend reinvestment program, if a company offers it, your dollar amount will go up and the equity that you have will go up. So the next time you get a dividend payment, it compounds and then throws it back in, which then compounds again. It's essentially compound dividend growth. If you know compound interest, it's compound dividend interest. And again, if all of this is pretty crazy and you want guidance with it, the Figuring Out Finance series will give you all the guidance you need and more with class projects to help you take that information and immediately understand it and put it into use that day. Now, I just mentioned something, compound interest, because that's a great segue. Because the next thing I want to talk about are interest rates. Interest rates are something that unfortunately there's very few times that it helps us. The one time that we'll see it help us is in those money market accounts and in savings accounts, where you will collect interest, and that is how the bank gives you return. But most of the time you're going to deal with interest, it's because you owe money. Whether that money be in the form of credit cards, student loans, car loans, home loans, and more. Interest rates will increase how much money you need to pay them as a cost for having them lend you that money. These interest rates are a percentage. So if you owed $100 and you had a 10% interest rate, that amount would go up to $110. But then instead of it just going up another $10 to $120, we compound it so that $110, you now take 10% of that. So it's 11. So you get 121. 10% of that. Now you get 133. And it goes up more and more over time. So the higher the interest rate and the longer those loans are outstanding, the more and more you will owe. Interesting thing from when I did this back in high school, I found that with the interest rates of when I was in high school in 2010, if I had bought a home with a 30-year loan, I would have ended up paying double. Literally, I would have paid the full amount of that loan in solely interest. So if the home was $500,000, I would have ended up paying $1 million total. $500 in what I owed them and $500 in interest. If you're interested to learn more about interest rates, we already do have a webinar on that from 4/23/21. That webinar is called Interest Rates, and we'll talk about in that one the differences between compound and simple interest and how interest plays for us, but mostly against us. And yes, in our Figuring Out Finance series, we will have you take a look at interest rates and apply it to something that matters to you. If one of your savings goals is saving up to buy a car, it's going to help you to know what will you actually pay in the principal, which is the money that they lent you, and also in interest, the amount that they charge you for the convenience. We will also help you to understand how changing the length from 3 years to 5 years, 5 years to 10 years, or in the case of a house, even 20 to 30 years, how changing that length also affects the amount that you will have to pay back in total. Finally, we come to the last point. Because we mentioned before that savings accounts will give you some profits in terms of interest rates, but again, that's the only place that we will see interest rates help us. Typically, the interest rates are going to come from us borrowing money. Now, let's summarize. So we've talked a lot today about many different subjects, and many of them are unfortunately unrelated to each other. Sadly, that was part of the design of this webinar. It was not meant to take you on a journey from point A to point C. It was meant to bounce around and show you all of the different things that, whether you like it or not, you're going to have to know. It's teaching you about how you get your money and how you owe money as soon as you earn it. It's talking about when you earn your money, how do you start to put it to immediate use, or if you can afford to, putting it aside to save for the future, both in terms of an emergency fund or long-term investments, retirement accounts, and more. It was meant to be a high-level, broad look at 6 different topics that are necessary for any well-rounded financial education. Some of these topics are things that affect us all: cash accounts, budgeting, interest rates, and taxes, while others affect us more as we start to invest, such as investment accounts and dividends. And if all of this is crazy and you want guidance for how to go through and navigate all of this, but most importantly, how to apply it in your life, today, tomorrow, and in the future, I highly consider that you consider, sorry for the pun, the Figuring Out Finance webinar series. This series is going to be a 5-week, 10-lesson course that starts on Monday, July 11th. In addition to covering the 4 last topics that we talked about today, it's going to go in much more detail about them and also provide you optional projects. Again, everyone's goal in taking the course will be different. Someone has money put away already and they want to start investing with it. Others want to learn and gain a little bit more control over their earnings. Are capital gains a dividend tax-free thing? No. They will be reported in the form of a 1099 div form that you will get from the company. But again, it depends on where it's held and if it's in a tax-advantaged account or not. So in a brokerage account, you will receive a form called the 1099 div. If it's not in a brokerage account and it's in a retirement account, it depends on the type of retirement account. All right. So again, the Figuring Out Finance series is not just information, it's action. It's how to take what you learn in the series and immediately apply it, whether you're ready to start investing or you're ready to start saving. This is the class for you. And mainly this class is meant to be for students, people that are starting to earn their first few dollars or are ready to start their financial journey and want to understand more about it. So again, this class series will be fun. There are no grades. There are no required homeworks. Instead, every class will have an optional project to help you take what you've learned and apply it immediately. Sign-ups for the class series are through Zoom, and you can still sign up. There are a couple seats left. The link is in chat right now. And Sectors Made Simple annual subscribers will get a 50% discount on their registration. So if you are a Sectors Made Simple subscriber, you want to register for the class either for yourself or for a loved one, you can send them your referral link. But first, please email us so we can send you that discount link. If you are a member and you go to that link that I posted, it's not going to show the 50% discount. If you want that discount, please email us at support@sectorsmadesimple.com and we'll get you set up with that discount code. So, today was 6 tips, and on Monday we start our 10-hour, 10-lesson series all about figuring out finance for ourselves and setting our own goals for how we can start to invest our money simpler. Thank you all so much for joining today. Have a great weekend, everyone, and I hope to see you in class on Monday. Take care.